This is Bazaar Morning Call, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant Nair, and with me are my colleagues Surabhi and Nigel. Guys, hi. Good morning.
Good morning.
Good morning, Nigel. Good morning, Prashant. And yes, I know we're going to talk about markets, cues, and what's happening in the global setup and all of that. But I just want to start by wishing our scientists, those fantastic men and women at ISRO, all the very best, because Vikram is making its way to the moon, I think, between 5:30 and 6. I know where I'm going to be absolutely glued to that YouTube or television feed. Really hoping for the best. Maybe the fourth country to finally land on the moon, and the first to land on the south side. And that's going to be quite something.
Yeah. And I think that is important because that's where the water is.
Yes.
That's where there's a reason why
there's a race.
Yeah, absolutely. That is important. So, yeah, absolutely. I mean, that's later today. By about 3:30, post 3:34 or so is when we're expecting that to really happen.
Just a small point yesterday, because I was really excited about this, reading a lot about this. After, USSR, not USSR actually anymore, but Russia's, unfortunate events over the weekend with their mission kind of terminating, I think all eyes on this one. And if India manages to do this, it'll be quite a scientific marvel. Yeah. And then to get out for the rover to get out on the surface and start experimenting over the next couple of days, it would be indeed a very proud moment for all of us.
Absolutely. Well, it's going to be something. We'll of course get you live coverage of that later in the evening. Well, as always, let's quickly look at the markets then and take a look at what you need to know as we begin another trading session. So here we go. We got yesterday, which was a day of consolidation, right? I mean, nothing happened. The Nifty was absolutely flat. Mid-cap index made a new all-time high. We'll talk more about this a little later and put this into context. But we did hit a new high in the mid-cap index. The small-cap index, as of yesterday, is just about 200 points away from hitting its own high. So not very far away. Could happen with a day or two of gains. From global markets, there's not very much by way of action. The S&P was down a little bit, about 0.25% or so. I think you've got the Nasdaq, which was absolutely flat, so nothing. The 10-year is holding. It was down 1 or 2 basis points, but holding above 4%, 4.3%. The dollar index actually went up a little bit, about 103.59, 103.6 or so. So that's the global setup. As I said, I mean, things are holding still calm. Later today, we'll get out of the U.S. market session the NVIDIA results. That's the advanced chip maker, which of course has been the poster boy for all the AI-related frenzy. And those numbers are going to be important for the entire tech complex in the U.S. For the wider market, what is of course a significance, as we've highlighted for the last 2 days in the U.S. is the Jackson Hole Symposium and Powell's speech, which is on Friday. So that's the U.S. action for you. Nothing incremental or new as we begin today's session. Now, the Nifty, as I said, we had a bit of a consolidation kind of session. Because the markets moved up a little bit, we need to now close above 19. The level I put out yesterday was 19,400, which is where the markets have been around for the last 2 sessions or so. We need to close above it. We ended just under it, like the previous day. We need to close above the upper end of the falling channel, which has come up a little bit to about 19,440. So that's the first level to really sort of keep an eye out on. Then you've got the 20-day moving average. I mean, the levels have not, I mean, the numbers have changed a bit, but the logic and the markers remain the same. The 20-day stands at 19,540 or so. Support is the lows that we saw last week, which is 19,253. So that's the setup broadly on the Nifty. On the Bank Nifty, we get the Bank Nifty did not cross the upper end of the rising channel. Resistance then becomes yesterday's high, which is 44,151. Again, that's a very, very near-term number, but the Banks index has been the weaker of the two, the Nifty and between the Nifty and the Bank Nifty. So yesterday's high, the first level, 44,151, and support then comes in unchanged at 43,600. Looks like the market's kind of, the index, the Bank Nifty that is, has bottomed out around those particular levels. So, just a kind of a quick look at the levels which are in play. The implied open is indicating a 27-28 point lower start. Maybe we get a bit of a quieter start once again. Intraday, you get rallies, but they also sometimes get sold into like yesterday. So unless you're a compulsive trader, I mean, I think the advice still is to kind of sit on the sidelines and wait for a clearer kind of trend to emerge in terms of the index, the indices, both the Nifty and the Bank Nifty. Stocks, of course, I mean, it's a whole different ball game with momentum chasing so many different parts of the market, so many stocks, sectors, subsectors which are participating. So we'll talk more about that a little later. Surabhi.
Prashant, it's like, right, we were discussing yesterday, it's as if there are two different markets. One that looks at all these global cues and US indices and what's happening to bond yields. The other that just doesn't care.
The small caps don't care, Surabhi. I mean, it's 2%, 5%, 2%. They don't care.
4.3% yield, 4.5% care. I mean, it's a completely different market, even in terms of sentiment.
It's like you're going to this ballroom dance. Everyone's doing the classy dance out there. But the small caps are saying, this is my space, right? I'm doing the break dance.
Yeah, absolutely. I don't care about the walls and the jazz.
I'm wearing my loose pants, baggy shirt. I'm on.
I'm rocking it on. I think you hit the nail on the head.
We know what Nigel did, huh?
I could have a vibe, yes.
Let's not get there.
Maybe on Friday. But all right, back to the markets. Just to add to the points that Prashant was making, obviously that yield is in focus. And yesterday there was some relief because at least that number came back down to 4.3. But the markets are a little nervous. There's no taking away from that. Remember, the bank stocks are the ones where there is some pressure. I mean, it's not a big slide or anything. But the other fact that this market is digesting increasing downgrades of U.S. banks. We had S&P, of course, on Monday come out and downgrade a couple of mid-sized U.S. banks, specifically the ones that have higher exposure to commercial real estate. And that's a big talking point in the U.S. as well. What is happening to the realty market there? And the spillover sentiment was quite evident on the others as well, the big boys. JP Morgan, Wells Fargo, Bank of America, you name it, Citi. All these stocks were down between 1 and 2%, not entirely able to shrug off what the rating agencies have been increasingly saying. So that's another watch point. Jackson Hole obviously is the big one. We will probably hear the Fed chair speaking on Friday, and perhaps markets will tread water ahead of that. Not too many data cues from China this morning. Some PMI surveys in Australia, which are negative. The Japan macro data slightly positive. So it's all over the place. Nothing very substantial in terms of big cues from Asia today. Oil is range bound, and that's a good cue for us at least. I mean, it's still around 84, 85 on Brent, so there's no big move on oil. I just want to cap off by talking about the way the flows are shaping up, the FPI flows in our market. Yesterday, we had a sell figure yet again. It's the fourth consecutive day of FPI selling, where they sold off about 500 crores. It wasn't a problem because domestic institutions have been buyers. They netted that off almost entirely with a buy figure of over 500. But the fact is there is consistent FPI selling. In fact, the inflows have petered down, and it's important to put that data on the table as well. These are the bars I'm talking about. Look at that, this blockbuster rally that we had in May, June, July. A lot of it was courtesy. There's a huge wave of liquidity that was sweeping through our markets, 45,000 crores, 47,000 crores on a daily basis. That's come down quite substantially. It's even lower than April. We are on August 23 today, so let's see how that plays up. But the fact that there's some pullback of FII money, that's something that perhaps worth putting on board. But Nigel, you tell us in terms of levels, in terms of the key triggers to watch out for. What are you looking at?
Since we're in this band of around 350, 400 points out, it continues to remain a scalper's market. I've been making this point for the last few days. So that is, you buy the intraday dip, you sell if you get a bit of a bounce, but you don't carry your position. And that seems to be playing out as well on a day-to-day basis. Well, just to revise what's happened in this fiscal year so far, you'll see the Nifty has done quite well. But the broader markets, well, that's where the real party is. So in case, you're looking at the Indian markets, you're saying it's quite boring, we're moving 200-300 points. Well, there are plenty of stocks out there that are making big money. So it's a stock-specific market, so to call it. Now, yesterday, you'll say the Nifty ended flattish. Well, why did that happen? You pull up the Nifty Financial Services Index. That played out the expiry yesterday. And there's a bit of an overlap with the Nifty Bank as well. Both of them ended to the low point of the day. And that's because the Nifty Financial Services Index played out expiry. Now, you also had another, point that is one small part of the market that's dragging. The Geo Financial Services, well, that's listed. And unfortunately, it's hitting the, the lower circuit because of those passive outflows and the likes. So that was down close to around 5%. That's dragging the index by close to around 10 points. And now we know that, it will continue to remain part of the Nifty as well as the sensex for a few more days till it doesn't hit circuit for 2 more sessions. We have clarified this with the exchanges as well. So it requires 2 sessions where it doesn't hit either upper or lower circuit. Then it will make its way out of the Nifty as well as the sensex. Well, moving on then, what are the FIs? How are they positioned? Well, they have 57% of their positions on the short side. Nothing has changed too much. On the option side, there was some call writing yesterday. 19,400 call, 19,450 call. There was some writing that we've seen at those levels. But if you look at the highest open interest on the call side, well, post that yesterday's edition, the 19,400 call has the highest open interest, close to 1.5 crore shares. On the put side, the 19,300 put has the highest open interest. So you plug in both those 2 premiums. You add the premium to the call, you deduct the premium from the put, and you'll get your levels. On the downside, 19,270, that becomes the day's support level. On the upside, 19,450, that's a very, very crucial mark because of the call writing we have seen at around 19,400 or thereabouts. The 50 DMA, that's somewhere the mid mark at around 19,335. The Nifty Bank as well, it's finding resistance at around 44,200 also. Just putting out the broad points out there. The recent low and the 100 DMA, you'll want the Nifty Bank to hold on to those levels. The GIFT Nifty suggests that we pull back a little bit. I think if you get a little deeper dip, not 20, 30 points odd, as we have seen, 50, 60, 70 points odd, maybe you look to buy in and exit the position as well if you get a bit of a bounce. Stop loss as well, most vital. So a scalper's market, so to call it.
Okay, that is indeed what it is. Let's quickly kick things off then with the equity call of the day. Amit Sachdeva of HSBC says the FTSE India index is up 16.7% in US dollar terms versus the FTSE Asia ex-Japan, which is down 5.2% as of August 21. This is led by $21 billion of FII flows, well supported by strong earnings outlook and relatively stable macro conditions. After this rally, he says India valuations have risen. Inflation has shown a somewhat worrisome uptick as July inflation came in at 7.4% and crude has inched up. Amit says, amid escalating concerns on global growth, India still stands out, but earnings resilience is key to sustaining this positive momentum.
Okay, some money market views then. We have Kunal Sudani of Shinhan Bank who says that improvement in the US existing home sales for the month of July and the Richmond Fed Manufacturing Index for August joins firmer treasury bond yields and in turn a firmer dollar index. He says traders will likely keep their powder dry for the main event on Friday with US Fed Chair Powell's Peter Jackson Hole. He hands for the USD INR 82.85 to 85.9 to a dollar acts as a support, while 83.2 to a dollar is the resistance.
Let's move to bonds. Neeraj Gambhir of Axis Bank says the 10-year benchmark bond yield traded in a range of 7.21 to 7.25% last week. He says bond yields initially spiked higher on higher CPI print as well as weak global cues, but retraced slightly on better than expected demand in the weekly auction. He says this week is light on data and market will take cues from Fed Chair Jerome Powell's comments at the Jackson Hole Symposium. He says weekly auction demand will also determine the course of yields going forward. He's expecting the 10-year to trade in a range of 7.18 to 7.28% for the week.
Well, we have a lot of stock-specific action to track for you. We'll get to that in just a bit in our special Top 10 segment, but we're looking at Crompton, BEML, RITES, Linde India, SJS Enterprises and TRF. 6 stocks that we're expecting to open up in the green. On the flip side, you have a few stocks like some banking names, Brightcom, NetWeb Technologies and ONGC that could be reacting to negative news flow.
Okay, well, we have Cameron Brand, Director of Research at EPFR Global, now joining in to take us through the flows picture. Cameron, always a pleasure. Thanks very much. You know, the last time you were on the program, you were telling us how India-dedicated funds continue to pull in a lot of money. So in a way, India kind of attracting money on its own, not because of global emerging market funds. Has that trend continued? Has it picked up? Has it slowed down? What's the latest?
It has slowed down. It's still happening, still consistently decent flows into dedicated India equity funds. But the diversified global and gem funds are not seeing as much money. In fact, they've seen outflows in recent weeks. And that obviously has an offsetting effect in terms of foreign portfolio capital flows into India.
Okay, Cameron, that's interesting. So you're saying that there's still money coming in India-dedicated funds, but there are outflows in overall diversified emerging market funds. Is this a trend that you'd expect to continue because perhaps investors are getting a little more nuanced about which emerging market they want to keep their money in?
I'm a little reluctant to make too strong a determination. We're definitely in something of sort of a summer lull, a summer holding pattern until we get another round of data and get closer to the next ECB and Fed policy meetings in September. So for the most part, flows into the funds we track have been fairly flat, middling to flat, with a few very specific exceptions.
Hi, Cameron. There have been a lot of these, PE exits as well, some of them, and that's why the flows picture in India is a little bit muddled. But you tell us, what is your reading of the situation? The India dedicated flows, what were they? And in comparison to what you've seen over the last few months, which is a higher number, has that come in? Is that tapering down a little bit?
Yes, it certainly is. I mean, there was a period there where we were fairly routinely seeing 2, 3, 4, as high as 600 million a week coming into those funds. And that's dropped down sort of certainly under 100 million. So a significant drop-off, still positive, but nothing like the levels we were seeing in July and June.
So that's a drop that you're talking about even in India dedicated funds. So basically there's a drop both in EM funds as well as India dedicated funds, you're saying?
Yes. The diversified funds, the flows are actually negative at the moment.
Got it.
India's are still positive, but at a much lower level than we'd been seeing.
Okay, got that. Okay, any sense on, then where the money is moving? Is it because bond yields are higher, it's just better to hold U.S. Treasuries? I mean, what is getting the money there? Which asset class?
There's 3 big pots. You just named one. I think people do want to sort of get exposure to sovereign debt at offering 4 or 5% while it's still available. We're starting to see a lot of cash go into U.S. liquidity funds again, which is not good news for those regional banks here that have been getting hit with downgrades. And flows into China equity funds continue to be very resilient. The consensus here seems to be that the more bad news you get, the greater the chance that China will sort of really dive in and step up the stimulus, and that you'll finally get a bounce that you can ride.
Okay, got that, Cameron. So the trade seems to be to shore up on China ahead of that much important stimulus announcement that everyone's been waiting for. Prashant?
No, I think that does it. Cameron, great to have you with us here. Appreciate you joining in here on the program. Thank you for joining us at CNBC-TV18. So, that's the story. The India dedicated funds are seeing a tapering off, still positive as compared to global diversified emerging market funds, which have turned negative. We'll take a very quick commercial break here. Our list of top stocks to watch lined up next with our research team. Stay tuned. We're back in just a bit.
Welcome back. You're with us on Bazaar Morning Call, and it's time to get down to all the stocks that could be active today. And our research team is standing by with the CNBC-TV18 list of top stocks to watch. Hi, guys. Good morning to all of you. Let's start first with Abhishek, because yesterday we got to know that the liquidity across the system, system-wide, has actually come down quite a bit. Abhishek, tell us more on how it may impact banks.
Banking system liquidity has turned deficit for the first time in FY24. So this is due to the incremental cash reserve requirement or cash reserve ratio, that is ICRR. Introduction by RBI in their previous policy of 10% on the increase in banks' NDTL, that is net demand and time liabilities. So the liquidity was a deficit of about 23,644 crores as of Monday. So based on Monday's data, the MSF window had transaction worth 89,813 crore versus 32,620 crore that was there on Friday. So RBI will review this ICRR either on 8th of September or earlier ahead of the festival season. Back to you.
Okay, all right. Thanks a lot for that, Abhishek. Well, let's hop across to Surbhi. She's here to tell us about Crompton. Morning, Surbhi.
Morning, Nigel. So Crompton's management met with a lot of investors yesterday, and here are a few key takeaways. Now, they've explained how they've embarked on a new growth focused strategy. You can expect multiple new initiatives by the management in the medium term. Also, it has identified and now looking to plug crucial gaps in its portfolios, specifically fan, pumps and lights, and they will also be increasing contribution from their smaller categories, which is small and kitchen appliances. Nomura says execution to these initiatives will be crucial for a re-rating. On the back of this, CLSA has upgraded its rating to a buy with a target price of 365, and Nomura has a neutral rating with a target price of 338.
Okay, well, that's one of the stocks that we'll watch out for. Surbhi, thanks very much for that. Now, on to Brightcom, right? I mean, this is a stock which has seen so much controversy over the last many years. SEBI finally came out with an order, and it's, it's a very comprehensive 70-plus page order. Rima is going to tell us more. Rima.
Thanks so much for that. So, in fact, this is SEBI's second interim order on the Brightcom group, and it's quite rare for SEBI to pass two interim orders on one particular company. So, SEBI, based on the prima facie evidence, observations, findings, they found irregularities in the company's preferential allotment. So, based on their findings, they're saying that there is a possibility that BGL, that's the Brightcom group itself, had financed the preferential allotment. They had submitted forged and fabricated account statements to show the receipts of allotment, to show the receipts of application money from allotments. Also, it's not clear, or it's not been completely accounted for, how the company has used the proceeds of the preferential allotment, which raises the risk of the possibility of siphoning off of the money from the company, the money which is supposedly have been raised on the preferential allotment. So these are some of the, prima facie observations and finding. Based on that, SEBI has barred the CMD of the company, that's Suresh Kumar Reddy, and the CFO of the company from holding board position in any listed companies. In fact, the CMD, Suresh Reddy, has to also square off all his open positions in the next 3 months. Not just that, certain other investors, which includes market veteran Shankar Sharma, has also been asked that he cannot dispose of shares in Brightcom Group for the next 3 months. The SEBI has directed the company to place this order before the board in the next, 7 days. Back to you.
Okay, all right, got that, Rima. Thanks very much. That's the latest on Brightcom. Let's go across to Surabhi Sataria. She's also watching out for a couple of names. Which ones are these, Surabhi?
So the first one on my radar is BEML. Now, the company has won an order worth 100 crores from Ministry of Defence for supply of command post vehicles. Next is RITE. The company has emerged as the lowest bidder for a project worth over 65 crores by the Railway Board. Now, this project is for testing and inspection of rails for Indian Railways for a period of 5 years. Linde India, the company has received a LOA from IOCL for setting up an air separation unit. Now, on completion of this unit, it will also operate and maintain the facility for a period of 20 years. The company is expected to fund this capex from internal accruals. And lastly, NetWeb Tech, which is a newly listed company, the 1 month lock-in period ends today. So there will be an additional supply of 20 lakh shares, which is close to 3% of outstanding shares. It listed at a 90% premium, but since then it is down 13%. So you can expect some pressure on that stock as well.
Okay, all right. Thanks a lot for that, Surbhi. Well, Vivek is back with us. Missed him for a couple of days. Vivek, tell us about the block deals. Plenty happening, right?
Well, absolutely. Yesterday you saw a very, very large block deal. Almost 30% equity of SGS Enterprises changed hands. Promoter group entity, Evergraph Holding, they sold almost 29.5% stake out of the total 34.5% stake that they held in the company. But the good part is now there is a lockup till November of 2024 for them to be allowed to do a further sale of shares. Sanders Consulting too, sold a rather 0.6% stake. But look at the list of buyers, some marquee mutual funds, all of them have picked up significant chunks. Aditya Birla Sun Life Mutual Fund picked up 6.8% stake, ICICI Prudential another 6%, Sundaram Mutual Funds under various schemes bought over 3% stake, and HSBC Global Investment Fund picked up over 1.5% stake. The other stock on our radar is TRF. Yesterday was a very sharp mover in the session. Morgan Stanley Asia Singapore PT sold the entire 1.8% stake that they held in the company at 232 rupees a share.
Okay, all right, got that, Vivek. Thank you very much. We'll watch out for all of those stocks. We will also watch out for this slight softness that we have in crude oil prices. Brent is below 84. NYMEX has fallen below 80. Manisha joins in with the latest. Good morning, Manisha.
Morning. Thank you for that, Surbhi. Well, last 4 or 5 trading sessions, we've seen 3.5% go down in case of the crude oil prices. As you said, we're trading below $80 a barrel for the WTI crude prices. The reason for that is the weak Chinese demand and the weak Chinese data that we have seen for the month of July and August come in. Also, there is further U.S. rate hike expectation to contain inflation. All eyes on Jackson Hole meeting on Friday for that. And then apart from that, there also are talks of resuming nearly 450,000 barrels per day via the Iraq-Turkey pipeline. If that comes in, then we are looking at further increase in supplies coming in. In any case, the U.S. production is at a 3-year high, so there are enough supplies coming in from that part of the world as well, keeping the crude oil prices under bearish trend.
All right, got that, Manisha. Thanks very much. So we will watch out for a lot of those stocks as well, both upstream and downstream, and see how they react to this drop in prices. We'll take a quick look at our top 10 list, and the ones that have positive news flow are Crompton, VEML, Rights, Linde India, SGS Enterprises, and TRF. Stocks that have negative news flow around them today are a lot of the banks because of this liquidity deficit in the system, Brightcom, NetWeb Technologies, and ONGC. Quick break on that note. On the other side, Nishal Maheshwari of Centrum Broking will join in for a fundamental stock check. We also get you excerpts from our conversation with Lloyds Metal and Energy MD Rajesh Gupta on the business outlook for the company. Welcome back. You are with us on Bazaar Morning Call, and it is time to get our conversation going on the fundamentals and some ideas in the market. We have Nishchal Maheshwari joining in for that. I think Nishchal is with us now. He's, of course, CEO Institutional Equities and Advisory at Centrum Broking. Nishchal, good morning. Good to have you on the show. So first things first, I want to start by getting your thoughts on the mid-cap, party, frenzy, call it what you want, that seems to be going on. Even as the headline indices, the large cap market seems to be consolidating. What's your take on it? And what are you advising clients when it comes to fresh exposure to mid-caps and small caps now?
So, morning, Surbhi. Yes, mid-cap is on a roll, basically. And I think that is what to do with it, basically, that as you see that the India seems to be in a very good situation, whether it's in terms of inflation, interest rates. I think these are what we've seen just last month is a more of a temporary phase, basically. And we see world over, basically, at least personally, I see that the rates are on a maybe as we go forward. So in that kind of a scenario, basically, historically, we've seen that the mid caps have always outperformed the large caps. And that is what we are seeing right now also. Secondly, I think liquidity is pretty good, basically, both in the banking sector as well as in the stock markets. And that's why you see in the outperformance, especially on the mid and small caps.
Okay, outperformance, especially on the mid and small caps. Let's just have the GIFT Nifty up for a quick second. Just take a look at what that is indicative of. It was kind of flattish, and we'll be interested to see if something has changed there. Still 27, 28 odd points lower is what we have. Nishchal, hi. Good morning. I'm going to just throw a couple of names to you, and these are the big movers from yesterday. Comment if you will. BHEL came alive in a big way in the last hour yesterday. Stocks at about 111 or so. HBL Power is another big mover. I mean, they make those anti-collision devices, but that's not the only thing they do. They also have, they have a fair bit of products in the industrial segment, telecom batteries, etc. And then the smaller hospital names, not the large Apollo hospitals, but Rainbow, Yatharth, Shalby hospitals, they all have been bid up in trade yesterday and over the last few sessions. So just pick what you like and comment, if you will, on what we're seeing.
Morning, Prashant. I think you're talking about two different buckets. Let me just pick up the first one, basically, which is largely the capex-oriented bucket. Which is either BHEL or HBL. And both of them, basically, if you really look at it in the last quarter, I think domestically also we've seen good order books, basically, across the sector in the capex side. Similarly, if you really look at it across the world, basically, there is something which is happening. And that is basically that the world is moving towards China +1. And that is driving the capex across the world. There is, I think, countries like US, Europe, and to a large extent, basically, most of these countries are now realizing that they want to bring back some of the industries back into the countries. So that's why you're seeing this kind of a capex role across the world. So it's not happening alone in India, but I see that similar capex cycle happening across the world. And obviously, India, both the domestic as well as the government capex is on a very strong footing based on the government policy. So we are seeing this kind of a role happening, basically, as far as capex-oriented stocks are concerned. The second one you said about the smaller hospitals, I think that I see more of a catch-up, given that the valuations of the larger hospitals basically seem to be now fully priced. So I think there is a good catch-up which is happening, basically, as far as mid-caps and small caps are concerned.
All right, Nishchal, request you to just stay with us for a bit. Let's focus on Lloyd's Metals and Energy. Well, it's been a big gain in the past 1 year, but it's corrected from the recent peak. I caught up with the company's managing director, Mr. Rajesh Gupta, from the Motilal Oswal conclave and asked him on his volume targets for the next couple of years and also how he plans to fund the sizable capex he has laid out. Let's hear what he had to say.
First quarter results were a little better than I believe the next quarter, maybe a little down. International markets have now stabilized, so I think the Indian market will also stabilize. And I believe that the quarter 3 would be better than quarter 2. Quarter 2 may be a little down than quarter 1.
All right.
Exact realization is difficult to define.
Okay, all right. So quarter 1 was good. Quarter 2 will be a little bit of a downer. But quarter 3 onwards, you're saying things will improve from here on. Great, we got that. Tell us a sense on volumes then.
Yes.
On iron ore, you were talking about 10 million tons. So that appears on the cards going by what you have done in the first quarter. So do you maintain that? And also DRI, in the first quarter, you did around 67,000 tons. Do you think you'll hit around 350,000 tons for the year?
So iron ore, 10 million tons is our EC capacity, and we would be able to achieve that. We have been front-ended in our manufacturing of iron ore because quarter 2 in the monsoons, we know that we hit a rough patch. But we hope to be equally after that. So we should touch 10 million tons. Quantity-wise on DRI, it was a very good quarter in terms of quantity. No, we will not achieve 350,000 tons, but definitely our capacity utilization will be much better than last year. I think we should touch around 270, 280,000 tons this year.
Okay. The big trigger, though, Mr. Gupta, for you is about your reserves. So could you tell us what is the extractable iron ore reserves as of now? You all were looking at it. I think it was nearly around 150, 200 million odd. But tell us, what is the updated number and is there a further potential out there?
Okay. Well, first I forgot to add one point on quantity. We will be going forward and looking at increasing the EC for next year, at least for next year, up to 12 million tons. In terms of extractable reserves, we have done a preliminary survey with the help of Tata Steel, and the reserves have come to around 180 million tons preliminary of hematite and around 550 million tons preliminary of BHQ. These are preliminary figures which are awaiting final studies. The drilling program has been completed, and so the BHQ would entail a beneficiation, which we are going, getting the technical clearances and thought processes on the technology clear on that. Our teams are visiting various reference plants to ensure that we do a good job of the beneficiation. This extent of beneficiation would probably be the first time in India, and that's how the reserves, the actual usable reserves, would go up very substantially over the year. The final exploration report would come out in the next 2-3 months. There's a bit of delay on that.
Okay, all right. 2-3 months, you'll know your exact extractable reserves then. Got that. Mr. Gupta, the other point that you made about the 12 million tons, so in FY25, you're saying the iron ore sales volume will be at 12 million tons once all clearances come about?
Around, once all the clearances come about, these clearances are easier than getting, because it's, I won't say automatic, but since we are a 5-star mine, the reserves are, the clearances are a little easier to get, and we would be going through that process right now, and by FY25, the total quantity would be 12 million tons.
Okay, all right. So that's heartening to hear then, because just a short while back, it was in low single digits, moving to 10 and then 12 million tons in FY25. We got that.
Yeah.
Also, if you could tell us, your capex plan entails that you're moving in forward integration, right? So if you could tell us, what is the total capex plan that you've lined up? Will it be funded via debt, internal accruals, or is there some equity raising plans?
As of now, the plans are around 4,500 crore rupees investment in one pellet plant of 4 million tons and one steel plant of 500,000 tons, including a backup capacity of DRI and power in the steel. This will be around 4,500 crore rupees total investment. This we hope to be funded. This will be over a period of 2 to 3 years. 2 years, you would say. So by 26 year ended, 26 it would be all under commissioning, and we hope to fund this all through our internal accruals.
Oh, that will be a tall ask then, but you seem fairly confident as well.
Yes, that is a tall ask. Yeah, definitely, because we are very confident we won't be raising any debt. So we have to achieve those figures.
What about, will you be looking at equity at some point of time?
At this point of time, there is no such thinking process.
Okay, all right. I'm looking at your realizations as well as your margins. For the first quarter, your blended margins were around that 27% approximately. And on an EBITDA per ton basis, it was roughly around 1,550 rupees. But when you last joined us, you told us you're looking at some cost-saving measures and that could increase the EBITDA per ton from here on. Give and take everything, the cost-saving measures, the realizations, the volumes, what can your EBITDA per ton steady state look like for Lloyd Metal?
So I think going forward, 1,500 to 1,800 would be the, given the scenario of the iron ore market, like any other commodity, goes ups and down. So I would say this was amongst the bottommost figures, and we have seen international pricing, like I said, rise up again once it touches $105. So we hope that that will be the case going forward. So it would be in that range plus, not minus, hopefully.
Okay, all right, 15 to 1,800 rupees. Final question, Mr. Gupta, before we let you go. Sunflag Iron, they have a big stake in the company. Have you heard from them what they want to do with that stake? And also, is there any plan to merge both these two entities? Since they have such a big equity holding, do you think it makes sense at some point of time, or is that completely not on the cards?
No, that is not on the card at all. They are an independent company. We're an independent company. That's not on the card at all. And no, we haven't heard about them, from them, what they wish to do with their holding.
If they want to sell, will you look to buy?
Since it's not on the board, so why talk about totally imaginary things?
Well, that was a good chat that I had with Mr. Gupta. The stock has been a big outperformer. The big highlight is that this year they'll do 10 million tons in terms of iron ore sales. Next year it moves to around 12 million tons odd, and they're continuing with their forward integration plan, which have laid out a capex of 4,500 crores odd. For the time being, though, we'll slip into a short break. Coming up next, Anuj Singhal will be joining in for Trade Setup. We'll also get you the top stocks of the day, and also we'll get in picks from our technical and F&O experts. You don't go anywhere.
Okay, welcome back. You're with us here on Bazaar Morning Call. Well, 13 minutes to go for the pre-open session. Anuj is here with a quick check on things. Anuj, morning.
Morning, Prashant. You know what? We have two markets within this market. One is for the large caps and one is for the mid caps. Let me just show some graphics on the wall. What the market has done. Now, this is interesting. This is Nifty. Look at what Nifty has done this month. It's down 1.8%, and this year it's up 7%. This year has been okay. 4 bad months, 4 good months, then a consolidating month. But look at what the mid cap has done. This month it's up 2.2%. That means a 4% outperformance versus the index for the month and a 15% outperformance for the year. This year it's up 22%. And same with the small cap index, up 22% for the year. Big outperformance compared to the large caps. And I think if you see it in terms of other indices, what they are doing, Nifty Bank is the problem point. It's actually down 3.6% this month, and this year it's up only 2%. And just look at this comparison. This is HDFC Bank versus IDFC First Bank, just to explain the dichotomy between the large caps and mid caps from perhaps the biggest stock in the market, HDFC Bank, which is down 4% this month and 3% this year, and compare that to an IDFC First Bank, which has risen 5.5% for this month and 56% for the year. So that really has been the trend for this month and for this year as well. Now, let's talk about today's trade because that's what a lot of people want to hear. The levels that I'm tracking, the first support on the Nifty is 19,334, which is the 50-day moving average. If the GIFT Nifty is right, we'll start somewhere around there. And the bigger support, of course, is 19,253, which has been the series low that we hit, I think, on the 16th of this month. The first resistance is at 19,443, which is yesterday's high. And the 20-day moving average has been proving to be big resistance, 19,550. That's the level to track. I think the bigger problem is with the Bank Nifty, which is clearly now in a sell-on rally texture. Till 44,205 is crossed. Even yesterday, it hit 44,151, and from there it slipped and gave you about 150, 160 points on the downside. Again, the first resistance is 44,151, which was yesterday's high, and the bigger resistance is 44,200, which is the 20-day moving average. Till that is crossed, I think there's a problem for the Bank Nifty. The first support is 43,860, going by the options data, where you have a decent build-up at 44,000 put. And the bigger support is the 43,750, the 100-day moving average mark. It's the rising 100-day moving average, which the Bank Nifty has been defending. But really, the conviction is much less on the Bank Nifty. And that's been in a sort of sell-on rally mode. On the Nifty, let's see. It's a contracting market. At some point, this range will break. But for now, we are in this range of 19,250 to 19,550.
Okay, got that. Thank you very much, Anuj, for the take on the way things are sort of set up today. Back to Nishchal for a quick comment. Nishchal, I just wanted to get your thoughts on Polycab. The reason I'm sort of pointing that out is just to let viewers know there is a pretty interesting upgrade that's come in from Morgan Stanley today, and Morgan Stanley has increased the price target to 5,550. The stock's closer to 5,000 right now, and this price target increase comes in after a massive rally, 100% plus on Polycab. What do you think of this wires and cable space? And do you like anything here, Polycab or its peers?
So we also have a buy on Polycab, and our target price has already been achieved given the recent rally. Obviously, if you really look at the broader space and the brown goods, it's only Polycab and KEI which have actually really done well in this sector. Most of the others are suffering, and that's largely because both of them are big players in the wires and cable space. And so what's happening there basically is on the back of good real estate sales, the first sales really happen is basically of the wires. And that's why you're seeing basically, even in case of Havells, basically the wires have done pretty well. So, but at these prices, I think it is fully priced. So I wouldn't be a buyer at these prices of Polycab.
That's the problem, right? With so many things in the market. Good, great businesses, great franchise, etc., but also great prices, very high P multiples across the board. That's one of the issues. Nishchal, stay with us. Mitesh and Sudarshan are with us with their technical trade setup. Gentlemen, good morning. Good to have both of you here. Mitesh, you go first. Absolutely flat, consolidatory kind of price action on the Nifty, at least yesterday. Things look different today, and what would you do?
Morning, Prashant. We have been actually calling for consolidation. So you can have a flat day, you can have a mildly positive day, mildly negative day. But I think it's the edges which are the focus points. So we tested the 19,250, 19,200 zone on Friday, and since then we've been trying to move up. That was the lower end of the range. Now I think we'll be slightly positively biased for the next couple of days. Maybe we'll try and attempt 19,600, 650 levels again. So in that sense, we have a mild positive bias on the short-term trading basis, but broadly it still looks like a consolidation of about 450 points. On the Bank Nifty, the levels or the ranges are about 43,400 on the downside to about 44,500 on the upside. Very similar kind of an outlook, but banks are slightly underperforming, so the focus is on mid caps and small caps.
Okay, got that, Mitesh. Stay on. Sudarshan, good morning. How are you approaching things on the main indices? Because that's where things are absolutely in a log jam while mid caps are flying away.
Yeah, good morning. See, the Nifty is in a narrow range. Yesterday, it made a narrow range day, a very narrow range. Usually, such a day should lead to a breakout or breakdown. But that's unlikely to happen because this range, narrow range itself, has been developed inside a trading range. So we have to look at the boundaries of the trading range rather than yesterday's price move. The boundaries are 19,200 on the lower side and 19,450 on the higher side. So inside this 250 point range, I don't think the markets are going to give us much movement. Some intraday trades are possible. Even there, the direction is not easy to predict. So it's much better to step aside, wait for one of these levels to be broken, at which point we buy a put if 19,200 is broken, or buy a call if 19,450 is broken. The Bank Nifty had a complete rejection yesterday of its attempt to cross resistance. It's an avoid.
Okay, all right. Thanks, gentlemen, for the call on the index. But Mitesh, let's come across to you first to run us through your calls for the day, stock calls for the day.
Morning, Ajit. I have 3 buys to a sell. Tata Communication had a very strong price and volume action day. So that's a buy with a stop below 1755 for targets of 1850. Gas Authority had a breakout few weeks ago, gave a pullback to 110 levels, now is bouncing back. That's a buy with a stop at 115 for targets of 122. And BEL is the final buy call, which made a fresh swing high. Buy here with a stop at 130 for targets of 140. And one sell call on PI Industries. Some profit booking looks likely over here. So sell with a stop at 37.15 for targets of around 3600.
Okay, all right. Mitesh, thanks for that. Sudarshan, what about you? What are your calls?
Well, Dr. Reddy is a buying opportunity. The stock has already been rallying. Again, a consolidation should lead to a further rally. Stop under 58.50. UPL is an intraday short. It's in a bear market of its own. Stop above 590, but keep it intraday. Hind Petro is another intraday short. Look at that large double top that it made, and it's moving down day after day relentlessly. There's a stop above 263. It's intraday. And Exide is a buying opportunity. Decent rally, a trading range, likely breakout on the upside. Buy with a stop under 258.
All right, got that, gentlemen. Thanks for being with us. We'll come back to you closer to market opening. Right now, have to take a very quick break. We will also be back with another guest, Murtaza Arsiwala of Kotak Institutional Equities. We'll be talking about the demand trends in the real estate sector, and we will look at the pre-opening rates.
Welcome back. Hope you're having a good morning. Well, in a short while from now, we'll be getting the pre-open rates. For the time being, though, let's get you some derivative strategies. Rajesh Palvi of Axis Securities joins us on the show. Hi, Rajesh. Good morning. Tell us what you have for us. First, your call on the index, and then you could also run us through your trading picks.
Good morning, Nigel. So, index is in consolidation mode. Both the indices, Nifty, Bank Nifty, are in range only. But looking at the near-term setup, Nifty is very well holding 19,300 support area. Looking at the call put concentration also in the previous session also, we have witnessed that again put writers have added their position at 19,300, 19,200 strikes. So support is very much intact on the lower side, but on the other side, 19,400, 500s are attracting the call writing activity. But looking at the overall setup, the broader market is showing a different behavior. The bullishness is there. Index is in consolidation. So if we get any dip towards 19,350, it's again, buying opportunity in the market. Your stop loss should be around 19,300. To play this move of the market, we are initiating here to buy call option of 19,350, which was closed at around 73 rupees. So if you get this call option around 60, 65 zone, you can buy this call option with stop loss of 35. And on the higher side, we are projecting target of 110 to 120 for this call option. So we are expecting that, if you get any chance on the lower side, market will show some pullback towards 19,400, 450 zone. So that where you can book the profit. On the bank nifty, 44,200 is still, not able to cross by the market, and that is the important level on the higher side. Once we crosses those levels, then short covering will be there in the bank nifty, and then we can see a good rally in the bank nifty. So till 44,200 not crosses, one should wait for that breakout level. On the stocks front, we are bullish on United Sprit, very strong price action in the previous session. If we go with the technical setup also, falling trend line breakout was there on the daily chart, long built up was there in the stock price. So looking at the overall setup for McDowell United Sprit, we are bullish and we are projecting target of 1,065 to 1,070. Keep stop loss of 1,010. Another stock is GMR Airport. A long build-up was there in the previous session. Stock has given a breakout of its previous last 3-week consolidation range. And looking at the overall setup, we are bullish and we are projecting target of 64. Keep stop loss of 56. And the third stock which we like, that is NMDC. Again, stock has managed to give breakout of its previous swing high, and looking at the overall setup, we expect that NMDC can continue furthermore upside, and possible target on the higher side towards 128 to 130. Keep your stop loss at around 117.
Got that, Rajesh. Thanks very much. Always interesting speaking with you, and thank you for those trades as well. Now, I just want to quickly put out on Market Laser a simple chart which puts into context the mid-cap rally that we've seen. I mean, the headlines in some papers generally overall has been that the mid-cap index has now joined the lifetime high club, right? And it's at an all-time high, which means, well, it could it's at a very high level. But you've got to contextualize that in terms of earnings. Where are prices relative to earnings? And to be able to do that, the simplest way to do it is look at P multiples for the index as a whole. And that's actually exactly what I've done with the chart which is up on your screen. This is all Bloomberg numbers. 1 year forward P multiple for the mid-cap index is now 23.4 times. Right? I mean, now 20, anything 20 plus, I would kind of consider to be high. I mean, it's not, even relative to its history, it's not exactly cheap. But what I did is look at the previous 2 instances where the mid-cap index made significant highs. I mean, the last one was made in October of 2021 when the market peaked out, right? So October 21, market peaked out, and then for the next 17, 18 months, all the way till March of 2023, just drifted and actually lost a fair bit of value. The rally, only remember, started in April of 2023. In October 2021, as you can see, the mid-cap index P multiple was 33.5 times. The previous high, which was lower, substantially lower than this high, was 33.5 times. It was wildly expensive. We're at 23.4 times. You go back one more step, right, and look at the sort of the big peak of that time, which was, in 2018, January of 2018, when, again, the mid-cap and small-cap index, if you remember, there was that SEBI circular which came out. Before that, the stock mid-caps and small-caps had an absolute frenzied kind of move, and then they topped out that month. The P multiple was 24.3 times, higher than where we are now. The point is that looking at absolute values, yes, absolutely, it does give you a sense, and at a stock level, 100%. But I think if you want to get an aggregate picture of where prices are relative to earnings, I think the P multiple serves a useful picture. So you are actually far lower than the previous peak of 2021 and slightly lower than the peak that we saw in 2018 as well. So I just wanted to kind of contextualize that. And of course, the simplest, the explanation is that earnings, this is 1 year forward, earnings have moved up nicely, sharply, is looking good. Nishal was explaining that to us earlier. And forward earnings expectations from this part of the market is also pretty healthy. Nishal is still with us. So Nishal, just tossing to you any additional thoughts. I mean, I think you did mention this earlier in some of your comments, but anything you would add?
So 2 things here, Prashant. I think one thing is basically, if you really look at it in the recent, maybe past few weeks, we have been seeing some selling coming from the FIs. And FIs historically have been largely invested into the large caps. So that's why you see basically that the Nifty is not performing, but the mid caps are performing. And now if you toss it around, you see that domestically, basically, there has been a huge flow, basically, which is coming to all the mutual funds in the mid cap and small caps. So one side you have selling coming in from the FIs on the large caps, and the other hand, basically, it's in the domestics are the major buyers in the mid cap and small caps because there is huge flow coming in those funds only. So that's why you see basically even in the recent last month also, you have a negative in the large cap mutual fund, 1900 crores negative, whereas in the small caps and mid caps, you had positive numbers. So I think this is what is leading to it. But somewhere basically this kind of steep outperformance is going to culminate, and we are going to start seeing, as I was telling you, one stock which I was talking just now, Polycab, I'm saying there are several of them basically where it seems to have hit the top. So we will see the performance coming back to the large caps over a period of time.
Okay, all right, got that. Anishal, thank you very much for joining in today. Good speaking with you. You have a good day, and we look forward to our next conversation. Well, the pre-open sort of rates are coming through, and what we're getting is actually an interesting opening with some, some upside, 30 points up on the Nifty. At least that's what the pre-open prices are indicating. Cipla is a stock to watch. Remember, Torrent Pharma is the latest name doing the rounds. That could be interested in perhaps buying out a portion or a large chunk of the Hamid family's stake. So that's news reports today, and therefore Torrent Pharma and Cipla, two more stocks that are in the news. Well, let's now turn the spotlight on the real estate sector. Murtaza Arsiwala, director at Kotak Institutional Equities, is with us to talk about demand trends and really, how you need to look at stocks given that prices have been rising. Murtaza, good morning. Thanks for joining in. So I guess, if I just put the data in context, it's pretty clear that if you compare things sequentially in terms of just the sales, there's a slight slowdown from Q4 to Q1. But otherwise, I guess demand has been healthy. You first tell us, what's your takeaway after looking at all the companies that have reported in the first quarter? Is the picture still healthy?
Sure. So just like you put it, if I were to look at things sequentially, there is some softness year on year. Still, things look good. On a more macro basis, when I look at things, 3 quarters straight, we've done north of 200 million square feet of sales. This is on an all India sort of basis, key cities. So that number is still good. Yes, we've come off the peak from, let's say, the 245, 250 number to more like a 230 number on an all India basis. Likewise, if I look at listed companies, the March quarter was fantastic. Obviously, if you recollect, DLF had that absolutely sort of stellar launch in Arbor last quarter. So you had a very, very strong base. You've come off from that base, And what is notable about this quarter also is that you've not had very meaningful launches. You should also be mindful that the last quarter was the quarter which had that, no limit on investment for capital gains, which sort of changed with the budget and sort of turns the corner in this quarter. So you had some rush of investments, purchases that were happening in last quarter. Now it's hard to sort of drill down the data, dissect the data between how much impact that would have, but clearly that would have had an impact. So I think it's a combination of lower launches, some amount of the fiscal benefits that were sort of being curtailed, which did impact sales in this quarter. But when I look at things in a more broader sense, things are not too bad for sure. Still continue to remain fairly healthy, and that's exactly how we are aligned, fairly constructive on the sector.
Murtaza, good morning. What stocks would you bet on from here? Assuming one doesn't already have exposure.
So we've been constructive on the sector for a while now. We've had these conversations over the last few years. Pecking order through, post this quarter does not change very dramatically. DLF, Lodha, Brigade still remain, amongst our preferred set of bets to play the story. Having said that, yes, the absolute upsides, all of these stocks have had a stellar run, just like you're talking previously about the market run. These stocks have also done very well in the last 2 or 3 months. So while we remain constructive, from a more medium-term perspective, the absolute upsides at this point may be curtailed, but, our pecking order, like I said, remains unchanged. DLF, Lodha, Brigade still amongst our preferred picks in the sector.
Hi, Murtuza. Good to see you in. Any sell on any of these real estate calls?
We've had concerns on Godrej Properties for some time in terms of their margins and cash flow profile. That sort of remains. A little more sort of weakish view on overall reality after the run-up. Like I said, we've started getting a little more selective, and that continues. So we've not really changed our stance very dramatically on stocks post this quarterly results. Just the absolute upsides or downsides, in that sense, more curtailed.
Murtuza, you mentioned your order of preference is DLF, Lodha Macrotech, and then Sobha, I think, right? So I just want to understand... Brigade. So just want to understand from here on, in terms of factors to track or, the key things that go into that decision-making, is it going to be valuations? Is it going to be the launch pipeline? Will it be balance sheet strength? I mean, all these things are important, I get it. But just in terms of priority, where do you have your, sharpest focus now, given the rally and the sentiment?
I think, so balance sheet's fairly comfortable. Valuations, even after the run-up, not too demanding. My focus point is going to remain launches. All of these companies have a fairly strong launch pipeline, fairly good business development as well. I'm not expecting anything dramatic to come even in the second quarter, given it's a monsoon quarter and activity levels are relatively low. My focus would be on the second half of the current fiscal. Once the festive season sort of kicks in, you should see a slew of launches across developers, strong pipelines, and how that response sort of comes through is what's going to be a key monitorable from my perspective.
Murtuza, on a lighter note, someone was telling me that you see, you get these messages, right? So-and-so bookings or sold out in 3 days, long, quick queue of people lining up to book apartments. Said, well, the trick is that, you can only launch a project once you have radar approval, but, what builders do apparently, and you would know this better, they sound out brokers, collect checks to only deposit them later. So by the time the clearance comes, the project opens, you already have a pool of whatever, expressions of interest or whatever as compared to the flat show. I don't know.
Okay, so let's...
It creates a certain frenzy, FOMO. I'm not saying the real demand is not there.
Let's put it this way. Let's think of that as marketing tactics
of
developers. Needless to say, a person would not sort of, a project of that large sizes wouldn't sell out. But I've usually not focused on whether they sold out in 3 days or 5 days or 7 days or over a weekend. In my head, I think I look at the bigger picture, step back and say, okay, let's take DLF's example, for instance, because that was a stellar one last quarter, and this quarter I've not seen any such launches. Now, whether you did 80 billion of sales in 3 days, 10 days, or even a quarter, the fact is to put together 80 billion of sales. I mean, look at the numbers. If you went back a few years ago, DLF was doing like 20, 30 billion of sales annually.
No, absolutely. I'm just saying.
So not taking away from that, but yes, I personally, from a market perspective, I don't focus on, whether they sold out in 3 days or 5 days. I think of that as marketing gimmickry and leave it at that.
Right, it definitely gets the headlines going, right, if nothing else.
But as a customer, you would care, right? You'd go right there. Get the check in there.
Prashant.
But that's marketing. I mean, you see that in real estate, you see that elsewhere as well. Murtuza, thanks very much. Great speaking with you. Appreciate your time here on CNBC-TV18. Well, that's real estate in terms of discussion. I think we're just hitting open now, Surabhi. So less than a minute to go.
Less than a minute to go. And the pre-open's telling us that today, at least to start off with, there could be a bit of a gain on the Nifty and the Sensex as well. Mid-cap index is up about 0.3%. Cipla, HCL Tech, Hindalco, Britannia. These are some of the early gainers going by the pre-open rates. Largely speaking, the screen is looking more or less positive. Even the Bank Nifty, for what it's worth, even the Bank Nifty is now suggesting that we'll start on the upside with the Nifty taking aim at 19,400 plus. So just a couple of seconds to go. And then the action starts off. Of course, mid-caps is where a lot of focus is going to be. But to start off with, large caps, you've got that 25, 26 point kind of open pop. Cipla continues to be in the news with respect to what the Hamid family is going to do with its stake. Some reports suggesting that Torrent Pharma is another contender. 2% up on that stock. We'll pull up Torrent as well just to see how the reactions are coming in. 1% up on Torrent. LTI Mindtree, HCL Tech, Infosys. So there is a trade on IT that's picking up right now. Even TCS is positive. It's the first early trade you can pick out. Tata Steel, Hindalco. So some metal stocks also in the limelight early on. On the flip side, Sun Pharma is a key loser today, down about 2.5%. Bharti Airtel is a little soft. And then you have some banking names like IndusInd Bank and ICICI Bank, Kotak. So watch for the banks once again. Nifty is already cooling off, so is the bank Nifty. But once again, Nigel, I mean, hey, it's like a repeat of yesterday, right? Large cap indices don't know what to do. Mid caps, it's just that party is continuing.
I told you it's a breakdance, right? The mid cap index continues. It's up close to around 0.5% odd in today's trading session. Let's pull up a few stocks. Crompton, Prosper analysts meet. The street likes it. It's up 2.5%. Vodafone Idea, there is some glimmer of hope that maybe they come up with the money. So for the time being, the street is rated positively. It's up 2.5%. A couple of other notable movers. Dalmia Bharat is up close to 100%. That's one of the cement stocks that are doing quite well. On the flip side, well, Brightcom, because of that, SEBI notice that we have, that one's down close to around 5%. Geo Financial Services, it's at lower circuit, it's down close to around 5% approximately. It's dragging the index by close to around 10 points odd, but otherwise, it's more or less a quietish start. I'll tell you what, the start when we open up 35, 40 points higher, it's a little bit more tricky because you'd like to actually to buy into a dip. When it opens up a little bit of a gap up, then you're in trouble. You prefer taking some money off the table if you had a long position, but let's see how that goes. The mid-cap index, that's taking your breath away, up 0.5%. Advanced decline ratio, you have 8 stocks that are advancing for every 1 stock that's declining. Good start.
Oh, yeah, it's a good start. And, let's just take a quick look at what else is going on. We've got things looking pretty healthy out there. Let's just have the top sort of gainers on the indices before we go any further. The movers on the Nifty, I think that'll give you a quick sense of how the screen is right now. We're just starting at this point in time, but I think maybe take a quick look. All right, we'll do that in a bit from now. Venugopal Gare is joining us now. He's Managing Director at Bernstein. Venu, great to have you with us here. Thank you very much for your time. It's always a pleasure. A couple of very interesting reports are coming through from you over the last couple of months or so, Venu. Let me just start, though, by putting into context your thoughts on where we are on markets and how you're feeling about it. I just put out a chart basically showing P multiples on the mid-cap index now versus previous significant highs. Back in October of 21, when that index peaked out, the mid-cap index was trading at some 33 times earnings. We're at about 23 times 1 year forward. Bloomberg consensus numbers. So it doesn't look crazy high. We've been higher, much higher still. Your thoughts, just to put into perspective.
Thanks, Prashant. So I would probably say that on the first thing is, I think I'm still positive on the markets. When I say positive on the markets, my view hasn't really changed with respect to downside risks. So positive primarily from here means that there are limited downside risks. So our broader thesis when we upgraded the markets in early April was that they would broadly be a broad-based rally, which primarily meant that both large caps and small caps should do well. Thereafter, about a month or two back, when index crossed 19,000, which is Nifty, which is when we started to probably start talking about the fact that we want to be more in mid caps than large caps, with a view that large caps have more or less sort of reached sort of a fair value. That was a broad thinking from a rotation point of view. And the argument that we made at that point of time is very similar to what you're saying right now, is the fact that mid-cap valuation relative to large caps, there was still a large gap in the sense that they had not peaked yet. So the reality is they have not peaked yet. But what is going to happen from here, in my view, is that even if I take a broadly positive construct in the market, for me, the next touch point is broadly elections. So until then the small cap, a lot of large, relevant, good quality stocks have actually moved quite tremendously. So what is happening now is you would see rotation into low quality. Low quality is defined by a lot of factors, by the way, but then the perspective is when you start to see this low quality move up fairly quickly, which is when you would start to worry about small cap overall peaking off. Now, at this juncture, when I think about it, if I take the positive view, then large caps are starting to look like, relatively attractive again. I mean, if you were to think of some of the large caps which haven't moved, as much yet. So maybe you see some rotation in that later in the year back into large caps.
No, so Venu, sorry, you're saying that a late stage movement to low quality is started, or it will start at some point? It's already happening.
Some of it has already started, but you tend to see a peaking when a lot of low quality would have moved up. Okay? So we haven't yet seen every low quality stock move up, right? Quite a few of them have just started moving up. We're still some time away from that situation where almost everything in mid cap, irrespective of the quality of the company, nature of the industry, goes up a lot. So that's when the risk starts. We are somewhere in the early stage of that where we're starting to see that happen.
All right. Hi, Venu. Good morning. Nigel on this side. Venu, I wanted to ask you about, we focus more on the PE and the multiple out there, but cash flows have improved as well. In the last few years, balance sheets are in far better shape as well. So give us a couple of numbers out there in terms of an improvement, particularly on the free cash flows.
Yeah. So Nigel, I guess you're right. I mean, it's an important point you've raised around free cash flows and how critical it is for the evaluation of any equity market. And more importantly, you're right, one always tends to look at price to earnings, but the reality is what happens below E, which is how is your operating cash, how is your working capital, and how much have you funded from a capex point of view to get that sort of earnings growth are more very important variables for a market cycle. Now, the interesting thing is if you look at data, we looked at the top 110 odd companies. I mean, this is 150 companies. We excluded financial companies, so 110 odd stocks, which represents almost a 1.5 trillion plus of market cap. So we're fairly relevant in terms of quantums. Now, the reality is that over the last 3 years, in aggregate, these stocks have generated close to about $120 billion of free cash. By the way, that is 2x of what India Inc., as I say, has generated for almost a cumulative 10-year period prior to that 3-year period. And interestingly, on an annual basis, we are like almost like 10x of what we were generating, let's say 10 years back, which is almost a $40 billion range of free cash. Now, the fundamental reality is that if you were to look at it, this is not just about IT services. We have seen a broad basing of free cash across sectors. Now, you in fact talk about autos generating a lot of free cash, for example, and some of these cyclical companies we used to really worry about. To that extent, even commodities did generate a lot of free cash in the previous 1 or 2, even utilities, right? So to that extent, what is happening is that provides you downside protection for the market because balance sheets are in a much better shape. See, end of the day, when we talk about formalization, that has been one variable, of course, which has supported some of the companies. But there is another factor which has supported is because companies have generally been very careful about how they manage working capital and more importantly, also very careful about capex use, right? Which is because they already had a lot of capex which they'd done earlier. This is a very important factor in my view for supporting the market. The only thing which we need to watch from here is how are companies going to now use the free cash, right? So that's a very critical variable because if they use it well and reuse it well into things which can generate productive growth, it's going to actually help the markets on a cycle basis. But if they filter away the cash flows, like we did after 2006-07, all the cash flows in that cycle were filtered away into really random activities, which is why we had a very long down cycle post that. So we need to watch out for that.
Okay. Venugopal, hi, good morning. I just want to get to your portfolio construct right now. I think what I recall from an earlier conversation somewhere in June, you were positive on some of the home improvement themes on autos, but you were a little more cautious on consumption. So tell us at the end of the first quarter, top down, big picture view, what are your biggest overweights where you still have conviction? For instance, I remember you like defense, but then now stocks have run up so much. And which are the areas where you're going underweight, where there's some caution coming in?
Yeah, so you're right. I mean, you're broadly right in terms of what my broader portfolio construct was earlier. Honestly, no changes until now. But the way I would look at it is that my conviction on the financial sector hasn't taken any backseat yet. And I think this is that pack of that large cap, which is still down. If you were to look at some of the frontline financial sector companies, the larger ones, they're still down YTD. So in that sense, I guess that's my largest overweight. And I'm treating it, as I mentioned earlier, not like a 6-month view, but a 3-year cycle. And that's what I want to play the financial sector for. It does make sense to basically keep buying in this situation. That's my largest overweight. Now, outside of that, if I were to look at my overweights, then sort of trickle down into smaller areas. So for example, in IT, my overweight within IT is actually consumer tech, which is something I had upgraded beginning of the year. So, the consumer tech companies, some of these new economy companies which are, related to food delivery or even fintech. So that's a key overweight for us within the IT sector. Autos, I'm actually neutral, in the sense that I do have some buy ideas, but I'm not looking too excited about a large amount of returns from here. And outside of autos, we still have consumption as an underweight, but we were trying to play anything linked to real estate out there, which could be pure direct real estate or an infra, right? So that is an area which we were still relatively positive on rather than pure direct consumption, which I wasn't really confident on. Honestly, nothing much has changed for me to change that view, even though inflation risks are sort of receding. Now, the only other area I would probably say that, outside of this is things like, energy or, these are or telecom. We're very, very stock specific out there. We're not really taking sectoral calls.
Got it. Okay, let me just ask you about financials, since you mentioned that is your largest overweight, and that's a long-term view. You're taking a 3-year call, so you're the right person to ask this. Tell us a bit more. I mean, there's been selling, for instance, right now in larger banks. Everyone's complaining about margin compression. And then on the NBFC side, we are set for perhaps big disruption with Jio coming in. And since you've taken that 3-year call, tell us, A, how do you see, Jio Finance coming in the landscape and what changes there? And just overall, what is it that you're most bullish on, even within financials? If you could just narrow that down.
Okay, so, I wouldn't mention a specific name out here, but I understand your questions. I'll give you a broader perspective around this. See, my financial sector overweight to a large extent has been driven through large banks, which, of course, from a regulatory perspective are a very different, entity altogether in terms of how they approach business, and their ability to, and of course, a very different model, raising deposits and then, using that for lending. So it's a very different model altogether. So we basically have been positive on the financial sector on banks, for example, and not necessarily on things like insurance, or and from an NBFC perspective, honestly, those were trades in our view, because it's a very, very small space now, honestly. And we were, if at all, playing the other space through fintech, which is something which we like, but, we can't articulate through stocks because we don't really have coverage. Now, the way I look at it primarily is that let's look at the top-down financial sector, perspective. See, this entire perspective about NIM compression, that is, of course, a possibility, when rates sort of change, especially when rate cut cycle happens. And I don't think that's going to happen very quickly, though. But assuming that at some point of time we'll have to go through that phase as well, right? If I were to argue that is basically a risk, that's not really a 3-year risk, right? If we were to look at it, these stocks have actually underperformed in some way, largely on that expectation. So I think that is priced in. So my thinking simply is cleaner financial sector balance sheets and the ability to, lend or grow credit growth, especially for the top banks with better deposit franchises, is something which is going to be visible in terms of growth. And they're not really over the top in terms of valuations. So that's a broad context that I have on the financial sector, top down on banks. The second thing I would probably say that, look, India still has, to a large extent, room for new financial player. Story is over. If you were to think about it, when I say story is over, is a new NBFC getting created or new fintech getting created. At the end of the day, there is ample opportunity for them to lend, and the nature and the areas they would lend, of course, will be slightly different. That's another important variable. Also remember that digitization, especially the way India is approaching digitization, is going to provide more opportunities. I mean, if you were to think of volatilization, UPI, post that we think about ONDC, now we're thinking about OSEN. Now, a combination of all that does what? It basically throws in, let's say, over a 3 or 5 year view, data on entities, SMEs, or small retailers who you didn't really have data to lend, right? And so what it means, even the banking sector over a period of time can do small ticket lending and reach out to a larger and wider sort of audience spectrum. Of course, cost of funding for those SMEs will also come down, but the reality is that that's basically what provides opportunities for credit growth, right? Even for the top end banks.
Venu, your last report basically talks about its title, Strategies of the Indian Government, right? And that's the thing. People, when they say they're bullish on the market even from here on, in a way, implicitly, the bet is sort of government continuity as well, political continuity as well, even though they don't sort of say that in so many words. So just wanted to, is that a big talking point when you meet investors, etc.? And any insights there? From a market perspective, there are so many stocks and sectors, right? PSUs in various categories. I mean, defense is a big area, big winner, big wealth creator, spends on infra creation, roads, and so many others. Banks, PSU banks is another big one, which are dependent on policy continuity, which depends on what Delhi does. Yeah, your thoughts on these areas? before the election?
Yeah, Prashant, I think after a few months we're going to be discussing just about elections. So I think market has been sleepwalking it, pushing that sort of discussion aside. A part of that is also because there is a broader market expectation of continuity of power, at least at the central government level. If I speak to any global investors, I have rarely come across a situation where there are major doubts. Now, of course, that could be a risk as well, that the market is actually not pricing in a change of government, right? The second fundamental reality is we've started seeing some questions, if at all, on what if there's a change of government, is there a risk, right? Very, very limited questions, if at all. Now, the reality is that if I were to put it in construct, continuity of power is very, very clearly required as far as continuity of policies are concerned. Now, historically, what we have generally seen is, whenever any change of governments have, happened, we have seen a situation where the good policies of previous governments have continued. So I'm not really worried about India then from a 10-year perspective or a 15-year perspective or a 5-year perspective. But the reality is you would have uncertainty for at least 12 to 18 months or 24 months till the time, these policies are digested, they relook at that, right? So that is going to be not so good for the markets, honestly. And I don't think we can form an opinion on that before May next year. So, that's like the unfortunate reality of what it is. And I don't think that state elections later in the year are also going to provide you any form of view on that. And we've done a lot of work on that, and we don't really think that, you losing a state basically means you lose the central government. There's enough data out there which proves otherwise. So we have to sleepwalk this, and we have to hope that this government continues in power. And if it doesn't, and there's a change of power, the first reaction, of course, from our side would also be to sell the market and then think what to do.
Okay. All right. Good chat today. Venu, thank you very much for joining in. You have a good day, and we'll look forward to the next one. That's the Bernstein view on the market, which, by the way, has slightly dipped. Now, on the headline index, you're absolutely flat with a tinge of red on the Nifty. Bank Nifty struggling. It's the same story. It's basically the trade extending from yesterday, where it's all about mid caps, large cap indices. Well, they're in the doldrums, so to speak. So that's the board. Quite a bit of red and green out there. Let's move on to our next conversation, and we're discussing hospitals. Hospital stocks have started doing well off late. In fact, most of them are in the green, up 1 to 2% even today. Narayana Health is the company on our radar. Of course, Narayana Health witnessed quite a healthy performance in the first quarter, with highest ever quarterly revenue coming in. Average revenue per occupied bed is also up about 12% year on year. Margins have increased as well. So let's talk about the overall, healthcare sector and, of course, the way forward for the company. We have Sandhya J, Group Chief Financial Officer at Narayana Health. Sandhya, good morning. Thank you very much for joining in. I want to just start by understanding, what seems to be aiding the sector overall. I mean, most players, like we just mentioned, that your average revenue per occupied bed went up, but that metric was up for pretty much all your peers. And this is despite seasonality. So what do you think is sort of happening over here? Is it a larger mix of foreign patients? Is it that, a lot more hospitals are opening up? How do you describe the sector tailwinds right now?
Good morning. Thank you for having me here. So I can probably first comment for what's working for us, and then maybe we can take a little view on the industry. So I think specifically for us, the improvement that is coming in the average revenue per patient or per bed is coming largely because of the work that we've done on the efficiency side. We've not taken significant pricing impact because of how we look at pricing. It's like our last lever, and we have also a social objective which we try to achieve, and therefore most of our improvements have come because of the work we've done on efficiency, improving throughput, which we have spoken about in many conversations. That's driving the improvement in realization as well as driving the improvement in EBITDA. Now, as far as the industry is concerned, I think there are a few factors at play. One, of course, is that the demand has continued to be robust after COVID. Initially, it started with a little bit of a pent-up demand coming back, but now we believe that all the pent-up demand is over, and it's not a post-COVID hike, and in some form, it looks like it's a sustainable demand. So the way we are attributing this is that COVID's really improved the awareness of healthcare with people. And secondly, I think our medical capabilities in India have also improved over a period of time, not just in the past 2-3 years, but over a period of time, the quality of healthcare that we are able to offer to our people is really good. So, for example, knee replacement, which used to be like an extremely complex surgery at some point in time, is like a morning evening now. There are robots in our many of our hospitals where the patient can walk in 2 hours. And because healthcare is becoming more easier to avail, I think a lot of the demand, both for high end as well as run of the mill operations, is coming back, and that's the trend that the industry is encashing on. I am not, at least we are not seeing a significant increase in international revenue. We can't comment for other hospitals, so I may not say that international growth is contributing to this good performance.
So, Sandhya, just a question. Got that. It's not really international for you, and you've not even taken too much price hike, as you mentioned. And despite that, your margins have been sustaining at this 20% plus band, I think 22% as of the first quarter. So if it's all internal efficiency, what about pricing? Do you see, some sort of a price increase ahead? And could that aid margins, or will you not go down that road at all, and you're happy where you are with respect to margins?
So we believe in predictability of pricing for our patients, and therefore we do a very structured pricing increase on the 1st of January every year. So for this year, our price increase is already done, and we have taken a very low single-digit price correction, mainly to account for inflation partially. So our next correction will come only at the beginning of next year.
Okay, all right. Hi, Sandhya. Good morning. Nigel on this side, and good to hear your views on the industry as well as on the company. Now, from a stock market perspective, valuation-wise, we have a couple of larger peers. Maybe, in fact, their mix is very different, whether it's Max or Apollo. But the bullish sentiment is maybe there is an opportunity to re-rate the stock, your stock, that's Narayana Healthcare. So my question to you is, on the average revenues per bed, you're in the high 30,000s odd, 37, 38,000 odd. Do you see that number headed towards 50,000, point number one? And on the margins front, you're in the early 20%. Do you see yourself getting to the late 20% margins, both these two, directionally?
So I'll start with margins and then get to ARPOB.
Sure.
Margins, I think we will operate in this range only. Maybe slight improvement, but we are not willing to go on the late 20% kind of margin, because that will need a significant correction on the pricing side, and that doesn't sit well with our the price at which we want to operate and the quality of service that we want to provide. We would probably operate at this margin. Maybe slight improvement coming out of efficiencies. We obviously are goaling ourselves on efficiencies, but we don't exercise the price lever so as aggressively. So therefore, I'm not going to give an extremely optimistic view saying we will go on late 20s on the margin side. As far as the average revenue per patient is concerned, so there are two matrices. The industry largely looks at average revenue per bed, but we recommend to look at average revenue per patient, because bed no longer remains to be the only factor by which care is delivered. There are a lot of daycare procedures, morning, evening procedures, which don't count in the ARPOB metrics. But in general, as an outlook on average revenue per patient, I think there will be growth which will be aligned to the pricing growth which we have taken. So, and also the other lever that drives improvement in ARPP is the more higher end procedures that we are able to do. So if we move up the value curve, then that also helps in improving ARPP. So those are the drivers that we will work on, and we will see improvement. I don't want to give a forward-looking number there, and I don't think you will see that kind of very drastic improvement that you're talking about, but we will progressively keep improving our ARPP as we have done in the past.
Fair enough.
All right. No, that's great to hear, Sandhya. I mean, it's always, when we speak with hospital companies, it's always a bit of a dilemma, right?
Asking that question on margins.
How will you increase your margins, average revenue per bed?
It's a catch-22 situation.
We all avail of healthcare services at hospitals, but the number of people who own hospital stocks is much smaller. So it benefits a few, but of course, I mean, yeah, it's a balance. But is that a durable competitive advantage do you guys think about it like that? That it's the fact that you're positioned in the more, cost-conscious way against your peers, for even those who are willing to pay. I mean, no one wants to pay outrageous charges. Do you see that as a durable advantage?
Yeah, maybe I want to clarify here as to what is cost conscious. At the end of the day, for all of us, costs are similar. While, people feel that healthcare is expensive, but what we don't realize is that there is no incentives which are available for healthcare. So there is we pay, the highest customs duty. Most of our equipments are imported because that kind of technology advancement has not happened in this country yet in terms of, the significant chunk of equipments. Construction cost is extremely expensive. We are competing with the mainstay real estate for, land. So at that prices. So, the input costs are all very high, and not just for Narayana, but for everybody else. And therefore, it reflects in the price in healthcare. Now, our affordable segment doesn't come from individual price of costs being lower. Of course, we try to be as efficient as possible in our operations, and that reflects in our prices. But we believe that the cost of overall healthcare will come down if we are able to maintain the discipline of how care is delivered. Quality, only as much care as what is needed. The price is predictable. For example, we upload our prices at the beginning of every year into our website. So therefore, when someone walks in, they already know what they can expect. So giving them predictability. So those are the places where I think our affordability play comes. And of course, because in many procedures, we do very large volumes. So therefore, we have that cost advantage relative to others, which reflects in our prices. So from an industry outlook point of view, I think there is a lot that need to be done in making the business viable for the industry. Because on the cost side, there are no interventions. But on the pricing side, government continues to intervene from time to time. In the last year, we had GST on bed charges. Now, constantly we have price caps on medicines that keep coming. Now, there is an overall economics that hospitals work with. And if we are only intervening on certain aspect of that economics and we are not working on holistic solutions, then it's a little difficult for the industry to keep responding to these partial measures. So there is work to do for the government to work collaboratively with the industry.
All right, got that. Good talking to you today. Thank you very much for joining in. We really appreciate you dropping by, and good luck for the rest of the year. We'll take a quick break. On that note, on the other side, Shikhar Agarwal of BLS International Services joins in. We talk about how demand is shaping up and the outlook for the rest of the year. Then we also connect with VD Nanavati of Gujarat State Fertilizers to talk about the company's performance in the quarter gone by as well as the outlook.
Okay, welcome back. So we've got, 10 points, 11 points on the Nifty, and 1,500 stocks are higher, 500 stocks are lower. 3:1 is what we have as far as the advanced decline ratio is concerned. Look at Shipping Corporation of India. It's the number one gainer, number one volume-led gainer in the index right now. 127 stocks up 8%. So that's a really big one. There are other PSU names as well. MMTC out of the blue, I can spot that being up 8%. Smaller real estate player, Shriram Properties, that has been doing well lately. That is, again, huge volumes. You don't see that. Shriram Properties, 85 stocks up 7%. It's the number 2 volume-led gainer right now. So, yeah, I mean, there is a fair bit of action starting to come back. Varroc Engineering is up about 5%. There is Atul Auto, which is up 8%, 411. Some of these names were not there in the mix earlier when we looked at, the broader market. SH Kelkar is another one, the fragrance maker. That's up 3.5%, stocks at 158. You go on the list, you find more names, but volumes start to come off a little bit. So that's the market for you. On the index, there's not very much really going on. Now, BLS International Services is in focus. The stock has surged nearly 150% in the last 1 year. Do note the company reported a good set of first quarter numbers, and during its first quarter conference call, the company indicated that it aims to maintain margins at 20% levels. Shikhar Agarwal is Joint Managing Director at BLS International, and he's joining us right now to take some questions. Shikhar, good to have you with us here. Thank you very much for your time. Prashant, this side, could you tell us how has demand shaped up in July and August? I mean, in the first quarter, consolidated revenues were down 14.5% quarter on quarter. led by about an 18% drop in visa and consular services. What explains that? Because, we haven't seen a quarter-on-quarter drop in revenues in the last 2 years now. Is there a little bit of fatigue, signs of kind of some of this demand tapering off, or is this seasonality?
See, if you compare our numbers year on year, we have grown 40% on a revenue basis and 150% on EBITDA level from similar quarter last year. So visa consular service business is, the revenue changes depending on, the season. So that is why it was just a seasonal issue. The revenue was less compared to last quarter. But if you compare to the similar quarter last year, the numbers have drastically grown at 150% at EBITDA levels.
Okay, all right. Hi, Shikhar. Good morning. Good to see you in. But how's the start been? How has the past 2 months or so? Demand is as strong. And also, I wanted to focus on margins. You had indicated that you'd like to see margins move towards 20%. I think you achieved that in the past quarter. But you were also talking about price hikes on new contracts. Has that happened? What is the quantum?
Correct. So demand has been going strong, whatever numbers that we've achieved in the first quarter, we are seeing good growth coming from across the world. Countries like China has now, opened up. We have opened up our offices. So I think we expect that, whatever numbers that we have achieved in the first quarter, this should maintain. Now demand is actually growing. So we are seeing more numbers than last year. On the margin front, as we have been telling that we've been aggressively looking at, constantly working towards increasing the margins of the company. In the last few years, in the last few quarters, we were doing 15 to 16% margins with small increase. And this quarter, finally, all the efforts that we were doing have given us fruits, and margins have jumped to 20% at EBITDA level. We expect the margins that we've achieved now to continue, and we will constantly strive to improve the margins. This primarily, the reasons for the increase in margins have also been because we have gotten increases in service charges. The newer contracts that we have won, for example, from the Spanish government, have been at higher service charges than last year. We have got increase in the prices for value-added services. There has been definitely an increase in conversion. The cost that we had achieved during COVID, the new way of working that we had learned, we have retained some of those, in the measures that we took. So those are the reasons for this EBITDA margins.
Okay, Shikhar, just a quick counter question on this China, reopening again. I recall when you joined us a couple of months ago or so, you said China and Russia, I think the volumes are still not back to optimal levels. So, in comparison to what you have seen as a percentage of optimal levels, what is it at? And also, how much do both of them contribute, to your total pie?
So, last year, the volumes from pre-COVID level, we were back at 70%. So 65% we were back at. So 30 to 35% used to come from Russia and China, on a pre-COVID basis. Now, Russia is still not, fully back. The volumes are still very negligible. But whereas in China, we have seen the volumes, have started to come back. We are seeing pre-COVID numbers in China. What we were doing, around 50 to 60% of them are already back, and we expect the numbers to grow further.
Sorry, Shikhar, so now how many countries do you do this for? Could you give us a lay of the land right now?
So we work globally in more than 64 countries, and we work with more than 40 client governments. If you see recently, we have won a lot of contracts with governments like Germany, Italy. We've won 4 to 5 contracts with Hungary, with Poland, with Portugal. So we are actually winning a lot of Schengen contracts, in the last 1 or 2 years. We have recently been re-awarded our Spanish global contract at a higher service charge. And also this time a new category of visa, which is the national visa, has also been outsourced to us, which will lead to an increase in further volume of applications for us.
And is there a big concentration? If you were to split the revenues by countries, the big blocks, what would that be?
So globally, now as a company, all our revenue is not concentrated in any market. They're split, in different geographies around the world. So there is no particular, split that we have country-wise, client-wise, but we are, I think, maintaining an even split with all our governments right now.
Okay, all right. Shikhar, the other big trigger is going to be that IPO, right? BLS e-services. When is it likely? What's the timeline? If you could tell us about that. I think you're looking to raise a couple of 100 crores. So just fill us in an update on that front.
Correct. So BLS Eve Services, which is a subsidiary of BLS International, it comprises of the banking correspondent and the e-governance business of the company. The revenue and profitability has really grown, compared to last year, similar quarter last year. So that company, we are planning to, dilute around 2.42 crore shares. It will be a fresh issue of shares. We've already filed the DRHP, and depending on the SEBI approval, which we expect will take a couple of months, we plan to list that company. The funds that will be raised, from that IPO will be utilized for both organic and inorganic growth of BLS e-Services. We see a big growth potential in that business. We are now already in all the states of India, including all union territories, with presence of physical centers. So we aim to expand on that, and very soon we will be getting more services incorporated in our existing centers.
Okay. All right, Shikhar, good to see you in. Thanks so much for joining in and wishing you all the best. You have targets for the year, 20% of margins, that IPO as well on the card. So plenty happening for the company. Looking forward to having a chat with you in the coming months. For the timing, though, we need to focus on to our next management, GSFC. Well, the performance in quarter one was a little bit weakish. It was because of lower prices of fertilizers globally, as well as the major decline in raw material prices. Mr. Nanavati, the Executive Director, Finance and Chief Financial Officer at GSFC, joins us on the show. Hi, sir. Good morning. Thanks so much for joining in and speaking to us here on CNBC-TV18. Well, one of the most important parts of your business that we track is the, caprolactam benzene spreads. Could you tell us what is it at for, as of now? What was it in the first quarter? And how do you see it shaping up? Normally, you give us a band in terms of spreads. Please go ahead.
Yeah, so in first quarter it was around $750. It is little less in July, but it will improve slowly. We see some uptick in all the industrial product prices. So going forward, we see some improvements in this, maybe up to $800.
$800. So you expect it to be in that vicinity of $800 to $900 for the year? Would that be a fair estimate?
Correct.
Got it. All right. I'm looking at your fertilizer segment, which is the larger part of your business. And there's a bit of a degrowth out there, and margins as well were down. Just wanted to clarify what went on there, and if you could tell us, was there any kind of shutdown that took place in the past quarter?
Yeah, there were plant shutdowns of urea and other industrial products plant in Q1. Okay. So availability of finished product was less to some extent. As far as the revenue and margins are concerned in fertilizer, there was a one-time effect of lowering of subsidy from January 23 and again from April 23. So that impacted the turnover as well as margin in fertilizer. But things will improve in quarter 2 and quarter 3, and we will see good growth going forward. At least in volume terms, as we have said, we expect some 15 to 20% growth in fertilizer volume. And we will try to protect our revenue for 22-23 for current year also, say about 11,000 crores.
Okay, so you're saying 15 to 20% volume growth in fertilizers. What about realizations and margins in the fertilizer business? Let's discuss that, and then we'll come to the other segment.
Yeah, last year was a historic year for fertilizer segment as well as GSFC. So government was quite liberal in the way to protect farmer. They were liberal into the industry also in form of higher subsidy. But along with input price coming down, subsidies are also lower on this side. So there is no direct comparison with 22-23. But overall, the margins will be definitely good for fertilizers. So as I said, fertilizer volume as well as margin are going to be good or stable, I would say.
Okay, so, I get that you're saying don't compare it to the last year because it was exceptional. You had a lot of subsidy. Let's talk about industrial products as well. What is the outlook you can give over there on volumes and some sense, because, the company shareholders will look at blended margins as well. And there, the operating margins, which have, they've shrunk to what about less than 7% from 17% because of these extraordinary factors. Now, you gave us the caprolactam spreads. You're saying volumes will go up. So just give us some estimation of what should be an expected run rate for operating margins, blended margins for the company by the end of this year.
Yeah, so blended margin could be around 9 to 10% in totality.
Okay, 9 to 10% blended margin, and the bulk of it will be volume based on the fertilizer side. Is that the right way to look at it?
Correct.
Got it. Okay. All right. So, what about the situation on the gas front? Last time you joined us, you said the supplies were not coming as per what was planned or as per what your expectations were. Is it better now?
Yeah, it is better now. All those supply constraints are gone, and prices are also. Supply constraints are gone, and gas prices are also stable now. From April onwards, it's quite stable and on the lower side compared to last year.
Got it. Okay, so that's good to hear. What about subsidy payments? Are they coming in time?
Yeah. Government has a good inflow of fund in form of GST collection, direct tax collection.
You want to give us a couple of numbers, sir, about your receivables? Are they coming on time? Yeah, please go ahead.
Yeah, so you may be knowing that with DBT, partial DBT, subsidy bills are raised on every week basis. So we have received subsidy up to first week of August for all the different fertilizer products. This is historically good. It has never happened in the past.
Yes. That's why we were very used to asking that question on how much subsidy and which quarter will the payments come. Good to know that it's happening almost on a real-time basis now. Just take us through what are your what utilization levels are you operating your plants at right now? Is there any plan to add fresh capacity?
Yeah, our utilization level has been more than 100% all the time, and we have some capex plan in pipeline. Some plants will be commissioning this year, FY24. Some will be FY25. And there are pipelines of capex under evaluation.
Mr. Nanavati, I have a two-part question. How much are you going to be spending on capex over, say, this year or next year? And in terms of capacity augmentation, by when does this come on stream, and by how much are you looking to bump up your capacity by?
Like, say, ammonium sulfate fourth plant will be coming in this year by December 23. That is a 132,000 metric ton fertilizer plant. So it will run at full volume maybe next year. Similarly, we have a small plant of HX Crystal that will be coming in stream, of course, next year. Then we have as a cost cutting and a renewable energy plant for solar power up to 15 megawatt that will also be coming by June 24. So mostly in this year there will be one plant that will be commissioned, ammonium sulfate 4. 3 more plants will be commissioned next year. That is HX Crystal, sulfuric acid 5th plant, and solar power plant of 15 megawatt capacity. And one more plant of urea revamping for reduction in the energy consumption in urea plant that will also be coming by, say, March 25. That is the capex of around 450 crores. So within these 2 years, we are going
Mr. Nanavati, sir, sorry to interrupt you. And the HX Crystal project, that caught my eye when I was looking through your presentation about what all you'll want to do. But give us just 2 numbers before we let you go. One, what is the total capex you have lined up for the next couple of years? And what kind of revenue potential does it have? Very quickly, sir.
So as we already declared, the total capex lined up is around 4,000 crores. And right now, I don't have the revenue numbers that will add up when everything is commissioned. Maybe next time I will join with that number.
Okay. All right. So we look forward to that discussion then, Mr. Nanavati. Thanks so much for stopping by and filling us in with your take on the company. Wishing you all the best. And please do join us in the near future, yet again, to give us an update on that asset turnover. Well, we also have a new listing that's flashing for you on the screen. TVS Supply Chain Solution list at a bit of a premium. I think it was indicating 4-5% higher. So it's a premium in comparison to the issue price as well. For the time being, slip into a short break. Mitesh Thakkar is waiting for us on the other side with some technical trades. Stay tuned.
Welcome back. Markets absolutely range bound, and there is that red on the large cap indices, which is now a little deeper, 20 points down on the Nifty. We have Mitesh joining in for quick check. Mitesh, what do you make of things right now? Any trades that you'd want to take at all on the Nifty or the Bank Nifty? Otherwise, any stocks?
I think I'll be stock specific right now. For the timing, I think the idea is that both the indices are going through some kind of contraction, so trading them may not be a very good idea. On the stock side, a buy on SRF, it's taking out of a nice intraday consolidations. Buy here with the stop below 2300, maybe 2295 can be taken. And look at targets of 2380. While Torrent Pharma, and I've been advocating this, the pharma stocks are now showing first signs of profitability. Torrent Pharma is a sell. Keep the stop at about 1965 and look for targets of 1890.
Okay, got that, Mitesh. Thanks very much. That's the equity call for the hour. Let's go across to Manisha now for the latest in commodities once again. Manisha, what are you watching out for?
Well, I'm looking at metals and it looks like a stronger, better day for metals, a second straight day, by the way, because the dollar index now seems to be getting stuck in a range. We haven't seen 104 break on 103 for that matter on the lower side as well. Also, there are gains because you are looking at the China building season now approaching as the monsoons kind of start to retreat there. The Chinese have also permitted nearly 12 provinces to issue 1.5 trillion yuan worth of special financial bonds, and that seems to be doing well for the sentiment into the markets. You have seen the steel rebar prices gain to a 2-month highs, and we are looking at the iron ore prices also gain up to a 2-month highs right now. Add to that the fact that the World Steel Association has come out with their July 2023 production numbers, and almost every country has shown a rise in sense of production there. Almost 63 countries report to World Steel Association, and we have seen an increase of 6.6% in sense of production on a year-on-year basis. The top 5 countries, which are China, India, Japan, Russia, etc., we are looking at stronger increase in production there as well. The best in sense of production gains clearly come in from India, but we have seen production gains coming across from those top 5 countries. You are looking at strength come back in case of copper as well. Overnight, we've seen nearly 1.5% of gains come in for this one. This is after a data point that was released suggesting that the China refined copper demand is up by 9% in the first half of 2023 now. Also, when you look at the overall inventories, you will really need more demand to support that, because last year was a deficit of around 196,000 tons. This year, the first half has seen a surplus of 213,000 tons is the reason you're looking at copper prices on where they are. But the best performance clearly comes in from the battery maker lead. We are looking at the prices trading at around 17-month highs. This is in Shanghai, and this is because the September delivery buying is much on the higher side, and that's not too much of inventories inside to be able to give those kind of deliveries. So we are looking at the spot prices now trading in the premium as well. Remember, the battery demand has been on the stronger side. We haven't seen inventories come in too strong, but with the kind of 50 to 80% of stuff that is in the warehouses marked for delivery for the month of September is what really seems to be poking the prices up right now.
All right, Manisha, thank you very much for that interesting set as always. Well, let's move on from back to commodities to stocks and companies. There's a list of 37 companies that will see various time frames of lock-in periods ending starting as early as today all the way until the end of the year, that is 31st of December. Hormuz is with us here with a list of all those companies and all the stock which will be hitting the market from here till the end of the year. Hormuz, hi, morning.
Morning, Prashant. And it's almost nostalgia, right? It's around the same time last year we had a slew of companies sometime around October or November which had their lock-in periods ending, and this year is no different. And it's a Nuvama note which says that 37 companies will have their lock-in periods ending starting today until the 31st of December. But more than the 37 companies, what is more important is the fact that 227 crore shares will become eligible for trading once their lock-in period ends. Now, these lock-in periods are anywhere between a month to as long as 3 years. But I'd like to begin on a different note, and I'll start with LIC, which is India's largest IPO. And that's because out of these 227 crore shares, 126.5 crore shares are of LIC. So it'll be 18 months in November when it'll be LIC will be listed as 18 months later, and the lock-in period for LIC will end on the 13th of November, post which the 126.5 crore shares will be eligible for trading. Now we come to the recent listings, and NetWeb Technologies, which was one of the successful listings in recent times, has their 1-month lock-in period ending today. And other names in this list include the likes of Concord Biotech, SBFC Finance, Yatharth Hospitals. And it's obvious that these names will also have their 3-month lock-in period sometime in between October and November. So I would not mention those, but the standout name in the 3-month list is Utkarsh Small Finance Bank, which will have 4.5 crore shares being eligible for trading. Now, moving on to the 6-month list, and in this list, it's more important to see the percentage of outstanding shares that will become eligible for trading rather than the number of shares. And in specific, I would want to mention Mankind Pharma, whose shares have almost doubled since their listing, and once their lock-in period ends on the 6th of November, nearly 70% of their outstanding shares will become eligible for trading. Now, in coming to the 1-year list, and Syrma SGS is the stock whose 1-year lock-in period expires on Friday, and other names completing that list include the likes of Fusion Microfinance, Dharmaj Cropguard, and others. Now, it was this 18 to 24 month list where I had mentioned LIC, but other than LIC, the other names in this list include Campus Activewear and Star Health Insurance, which have not done much since their IPO. In fact, Star Health is even trading below its IPO price. So it will be interesting to see the kind of equity that gets freed up and the reaction to these names. And lastly, it is the 3-year list, and it comprises of many successful names like Happiest Minds, Root Mobile, Mazgaon Dock, Angel One, and all of these names will have 20% of their equity freed up for trading as their lock-in periods end. And so it will be interesting to see the kind of impact that these stocks will have, outperformers and underperformers alike.
All right.
Okay, thanks very much.
Should we take a printout and stick it on your desk?
Yeah, it's a calendar. Now he's given us a nice calendar.
Something or the other.
Absolutely. Well, that's worth keeping in mind, that note from Nuvama. We'll take a break on that note. On the other side, our special segment, It's the Economy. Today, Lata connects with Vetri Subramaniam, Chief Investment Officer at UTI AMC, and discusses how this big rise in US yields might impact global and local stocks.